This is the lecture from Chapter 2 of your textbook, which is about financial statements, and we're going to get into some details about what IFRS says should be done with regards to the presentation of financial statements. Most importantly, financial statements should present fairly the financial and economic situation of a company, provide a faithful representation so that it's clearly their main focus. The entity needs to select and apply appropriate accounting policies, keeping in mind the GAAP hierarchy, so they follow that. They need to provide information that's relevant, comparable, and understandable, and they also need to provide disclosures where that's necessary. It's important to remember that note disclosure is not a substitute for proper accounting. You can't just have the notes, you've got to have the financial statements, and the notes are intended to simply enhance the financial statements, not replace them. In some rare cases, there may be situations where providing the best financial reporting may require departure from generally accepted accounting principles, and so that's allowed, but it has to be justified under IFRS. So let's identify what's included in the presentation, and the financial statements need to display some very basic things, but let's go through the list just to be explicit about it. They need to disclose the name of the entity, whether or not the financial statements are consolidated, the date of the balance sheet or the period that's covered in the other statements, the reporting currency, and the level of rounding that's used. So all those things must be displayed in the financial statements. At a minimum, a firm needs to prepare annual financial statements, and they need to be comparative. And unless IFRS permits otherwise, most of the time, though, comparative statements are the thing that needs to be presented and prepared by the company. In terms of the comparatives, there need to be at least two statements, and if there's retrospective application of a new accounting principle or a restatement, then there need to be three statements that are prepared, or three periods that are presented when the company shows their financial statements. Everything else being equal, it's going to be beneficial to keep the presentation and the classification of items the same from year to year. And so that just enhances comparability. So let's start with the balance sheet, the statement of financial position, and talk about the things that should be presented there. When assets or liabilities are sufficiently different, we want to separate those into different categories. And those differences can be based on size, they could be based on the function, the nature and liquidity, nature of or timing. And so there's lots of different factors that could cause there to be differences, but you're aware of this already. We don't include inventory and property, plant, and equipment in the same line item on the balance sheet because the assets are different. Also, if there are different measurement bases, for example, if we use the cost model versus the revaluation model, we would want to separate those assets on the balance sheet. We've got specific items that are identified in IFRS, like biological assets. Those, of course, have to be separated out. And we can present relevant subcategories if it's beneficial. And we also need to provide details regarding the share capital or the stockholders' equity. Regarding current liabilities, this is what the company should follow in terms of whether to classify a liability as current or not. The liability is expected to be settled within the normal operating cycle of the company. The reason it has the liability is because it's involved in the purchase and selling of inventory and those kinds of things for income statement kinds of transactions. That's what we mean by trading. The liability is due to be settled within 12 months after the reporting period. So there's our time factor. And the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. So another way to say that is they just can't defer it because the nature of the liability and the agreement is such that they need to pay it, so they don't have an unconditional right. If you have a current liability that can be refinanced with the same counterparty, say, for example, you have a loan with a bank, but the bank allows you to refinance that loan, then that liability could be reclassified as non-current if the firm wanted to. But this is only possible when you have the same counterparty. What I'd like to do next is to show you some examples of some balance sheets. So let's go do that now. I want to show you a balance sheet from Nestle Corporation, which is a Swiss company. And so their balance sheet begins here. So you notice they've got down here at the bottom, they've got the name, the Nestle Group. And we've told it it's the balance sheet. We have the date. Notice that the currency is Swiss francs, which is abbreviated CHF, and they are in millions of Swiss francs. So we're showing all those details that we mentioned in the earlier slide. And you can see that Nestle's reporting is very similar to what you're used to. Current assets are first. Well, first of all, assets are first with current assets, and the current assets are classified in order of the most liquid to the least liquid. Next comes non-current assets. Then we have the liabilities. Those are current first and then non-current. And then the equity is here. So some specific things I wanted to show you from this is, notice that Nestle's does not have any biological assets. They are not in the business of growing things. They are in the business of taking things that are grown by others and converting them into food products. Notice that they have, in their non-current assets, investments in associates and joint ventures. So we talked about that. I believe it was in chapter number 30. And so that would just be equity method investments basically that Nestle has. As far as the liabilities are concerned, we learned about provisions. And you can see that Nestle has both short-term or current provisions as well as non-current provisions. And so those are items that are liabilities with some uncertainty, but they meet all three of the tests. And so just want to point out that that's what Nestle has in terms of items that we've talked about with regards to the assets and liabilities. Next, let's look at Volkswagen. And they have a very different presentation. So Volkswagen's balance sheet, this still says Volkswagen Group. There's the date, and it says it's in millions of euros. Notice that they have their non-current assets first and their current assets second. This is the traditional European presentation. And so we have non-current assets first, and then we list current assets, and the current assets are listed in the order of the least liquid to the most liquid. And so that's traditionally how the European companies have prepared their financial statements, but you can see that Nestle doesn't follow that. They've kind of gone to the U.S. tradition. As far as the stockholders' equities or the equity and liabilities are concerned, notice that equity is listed first. And once again, this is the European tradition. And we have non-current liabilities first and then current liabilities. So I thought it was interesting to see examples of both. As far as interesting things that Volkswagen has on their financial statements, notice that they have some investment property. Not a lot relative to their total assets. It's a very small amount. But we learned about investment property, how they're purchasing assets that are intended to earn rents or to appreciate, have capital appreciation. And so there's an example of that on the balance sheet of of Volkswagen. They do not have any biological assets either, as we would expect. And you'll notice that in their liabilities, there are provisions for pensions, provisions for taxes, other provisions, both non-current and current provisions. And so those are other items that Volkswagen has, just like Nestle. So let's go back to the slides. Next, let's talk about other comprehensive income. And IFRS has got 5 components of other comprehensive income, whereas US GAAP only has 4. And so this first one, changes in the revaluation surplus for property, plant, and equipment, and intangible assets, that is the one item that is unique to IFRS. We learned about that way back in chapters 10 and 15. And so the US doesn't have this at all because they don't allow the revaluation model. The second one is certain actuarial gains and losses on defined benefit plans. Those are pension things. Gains and losses arising on translation of financial statements from foreign operations. The fourth one, gains and losses from the remeasurement of available for sale securities or unrealized holding gains and losses on available for sale securities. And then we have gains and losses on cash flow hedges. So numbers 2 through 5 are common to both US GAAP and IFRS. And number 1, the changes in revaluation surplus, that's something that is unique to IFRS as far as OCI is concerned. Something that relates to OCI that I wanted to point out is under IFRS, OCI needs to be reclassified, or items in OCI that can be reclassified to profit and loss, like the revaluation surplus. When those things can be done in the future, those are reported separately from the items that must remain in OCI all the time. So we talked about in the pension chapter that if you're using IFRS and there are actuarial gains or losses that occur, those need to be put into OCI and they stay there for the entire time that they're there. So let's look at examples once again. And this time, since we're already on Volkswagen, let's go look at the Volkswagen's OCI OCI statement. And here's their statement of comprehensive income. And they start out with their earnings after taxes or net income. Notice this subtitle right here, items that will not be reclassified to profit or loss. And we've got pension plan remeasurements. And so those kinds of things are included here. We have a subtotal for items that cannot be reclassified. And then there's a subtotal for items that may be reclassified subsequently to profit or loss. And so Nestle is following that disclosure or that grouping or reclassification with, I'm sorry, this is Volkswagen. Volkswagen is following that classification specification in their other comprehensive income. If we go look at Nestle, we can see that they do the same thing. So here is their statement of comprehensive income. You'll notice items that are or may be reclassified subsequently to the income statement, and then items that will never be reclassified. Notice remeasurement of defined benefit plans, so the pension things are appropriately noted and classified by Nestle in their OCI. All right, I thought those examples were a little bit interesting. So let's go back to the slides. And on the income statement, one of the things that I want to point out here is that IFRS allows companies to report their expenses either using the nature of the expense or the function of the expense. And so the nature of the expense, this is the item that the nature of the thing that we're spending money on when we pay bills. So for example, employee benefits expense, these would be like salaries expenses. Depreciation and amortization expenses, raw materials and consumables used, those would be things that would go into cost of goods sold. Changes in inventories of finished products and work in process, those are going to be cost of goods sold as well. And so we also could have things like rent or insurance, those kinds of things would be included in the nature of the expense. The idea behind the function of expense is that we're going to group these things by the function that they contribute to in the business. For example, administrative expenses, distribution costs. We could also have marketing. And so we think about departments of the business, that's really more, or department or a function of the business, that would be the way that we would then group these by function of expense as opposed to the nature of the expense. Which one can be used by IFRS firms? Either one may be used. And a survey that was done showed that 55 presented their statements on the income statement by function and 45 by nature. Sometimes you even might get a mixed presentation of what's going on with nature versus function with regards to these expenses. So let's look at some examples or just a little more detail about this. So I'm going to post this handout on D2L. And what I've got is a little table that shows the nature of the expense in the columns here. and the function of the expense across the row. And so we can have payroll where we're paying people's salaries, and those salaries could relate to the function of sales or the function of manufacturing or the function of administration. We could have insurance, which is the nature of the expense. We're paying for insurance, but there could be insurance costs in the sales department or the sales function. There could be insurance costs in the manufacturing function. There could be insurance costs in the administration function, and so on. And so I want you just to be able to distinguish between whether a company is using a functional way to report their expenses or they're doing it by nature. So let's look at some examples that I have here as well. And they're actually in a different example. So let's go here. So I've got Southwest Airlines here, and I believe that they have categorized these things by the nature of the expense. So they've got salaries, wages, and benefits. They have fuel and oil, maintenance, materials and repairs, aircraft rentals, landing fees and other rentals, depreciation, amortization, and so on. They don't break these down by the administration or the operations. They break it down by the nature of the expense. So this is a really good example of what we mean by nature of expenses. If we look at Nike, they are clearly doing theirs by the function. We have demand creation expense. So that's like marketing. Operating overhead expense. And so that would be the operations. So clearly Nike has done this by function. We can also go back and look at Nestle and at Volkswagen. So here's Nestle. And if we look at their income statement, they've got cost of goods sold, distribution expenses, marketing and administration expenses, research and development costs. So these are clearly functions of the company or departments. And so those things, Nestle is clearly using the function as a way to organize their expenses and not the nature. And the same thing is true for Volkswagen. If you look at their expenses, they've got distribution expenses, administrative expenses, and so on. And so in these examples I've had, hopefully you've seen good examples of both reporting expenses by function and also reporting them by nature. Change of the statement of the changes in equity. This statement is intended to show us how each component in the equity section of the balance sheet changes from the beginning of the period to the end of the period. So it's a reconciliation basically to show us how the changes work. So let's look at one quick example of a statement of changes in equity, and we'll go to Nestle for that. So let me get up. And so here we have the Nestle's financial statements, the balance sheet. Here's our statement of cash flow. And here we have the statement of changes in equity. So you can see that we've got share capital. We've got treasury shares. We've got translation reserve, other reserves, and all the elements of equity are here with total equity in the last column. And so we can see that we start at the end of December of 2015, and we show that beginning balance. And then here are all of the items that affected retained earnings during the year. And we end up with an ending balance here. And so we're seeing that reconciliation. And that's what the statement of changes in equity reports. And just wanted to show that quick example, just so you can see how that works. Lastly, we have the notes to the financial statements. And the purpose of these notes is to augment, not replace the basic statements. We want to include information about the way we've prepared our statements. We want to add additional description and supportive information. For example, we probably have a one-line item on our balance sheet for inventory, but we might want to break that down. For example, if we're Volkswagen, that shows our raw materials, that shows our work in process and the finished goods. We should have cross-referencing that is shown in the balance sheets. I didn't point that on the balance sheet of Nestle or Volkswagen, but I can do that in just a moment. It should disclose the accounting policies, and we can discuss estimations related to uncertainty that we had to make. And we can also talk about the nature and structure of our capital and how it's managed. So there's a number of things that we want to tell people, provide a lot of details in the notes. And so let's look at just quickly one last example. So first of all, I want to show you the cross-referencing that Nestle has in the notes of their financial statements. Here's the balance sheet, and you can see in this column, they list the notes. And so we've got the notes numbered here. If we want to find out about provisions, we go to note number, it looks like 14. If we want to find out about derivative liabilities, we go to note number 12 and so on. It mentioned that we have to disclose the accounting policies. And so here is Nestle's first note to the financial statements. Here are policies that they disclose. They talk about foreign currencies and other things. Notice that the consolidated financial statements comply with international financial reporting standards issued by the IASB and with Swiss law. So they're being very explicit about the system under which these financial statements are being prepared. So hopefully that gives you some interesting examples to look at with regards to the presentation of financial statements. And that is the end of this lecture.